Welcome to the deep dive video update. This is a video that I do once a week where I pull out some of the charts that I didn't use all that much throughout the week. And we have to look a little deeper at those charts. That's why I call this the deep dive video, because it's not always apparent what's going on. There are also some other charts that are unique just to this particular video. And I kind of put them all together and present them this way. It's kind of a potpourri or a catch-all, or I didn't really know where to put these charts in other videos. Those other videos are long enough as it is, so I ended up creating this particular video. And this is being prepared for Tuesday, September 2nd. All right, this is a chart that I only use in this particular video. It's nice to look at this about once a week to see, okay, where is fear in the market right now? This is a chart of the VIX, but the VIX is turned invisible, and over top of that is a 50-period exponential moving average. Look way over on the right-hand side, we're coming down. Now, as we were going down last spring, the VIX was really going up, but we never got above 20 long term. We got well above it there on a daily basis for a while. But since we finally bottomed and are coming back out, and setting new recent all-time highs with the S&P, the VIX has been coming down, and that's what we typically see in a more positive environment. Then we look at the momentum of the VIX, and it's pretty much flatlined right now. I use a MACD to see, are we tending to go higher, lower? Well, pretty much through August, we haven't really been going anywhere. Quite often, I'll show this chart in every daily video, but we're just flatlining right now, so there's really been no need to show this chart. Then I only show this chart when we're getting an extreme positive or negative reading. This is an RSI 9 short term to see, okay, are we spiking up to the upside with the VIX really going up quickly, or are we getting to the downside where we're becoming more complacent quickly? Right, excuse me. Right now, we're just about in between. I only show this chart if we get above 70 or below 30. We're not there right now. Then we look at the VIX and then do a correlation with the S&P, still getting very low readings overall. When I really start to focus on this chart is when this correlation spikes up and we go above this dashed line. We're not really seeing anything there right now. Then we look at the VIX and then do a ratio with the VVIX, which is the volatility of the VIX. And since we've been coming up out of the April lows, this ratio has been going down. It's continuing to go down, and that is positive. Then another fear gauge is the Ulcer Index. I only show this if we go above the moving average. We're well below it right now, showing that on a closing basis, there's not a lot of fear in the market. And we're tending to go down overall when we do a stock to bond volatility ratio. And as we've been coming up out of those lows, this moving average has been going down. The context is as long as it continues to go down, that will be more positive. Now, we saw a little bit of a drop down here. This is a ratio between large caps and small caps. When this ratio is really going up, that means large caps are outperforming. Well, small caps had a pretty good week, and they like the fact that interest rates may be getting lowered. The economy is still looking pretty good right now. And so we've seen this ratio coming down. We've been range bound for a lot of 2025. We'll see if this continues to drop or if we go back up into the range that we've been in. And we look at risk on to risk off. This kind of comes and goes out of the daily video. We're just chopping around right now. When this ratio is going up, that's more positive. That means the market is becoming more risk on. When we're going down, that means it's getting more risk off. Well, we were coming up out of the April lows, really moving up with this ratio, and now we've just kind of been chopping sideways throughout the summer. Then this is just for informational purposes. These are the percentage gains going back to significant lows in 2022, 2023, and then the April lows that we set in 2025, and how much on a percentage basis we've climbed since those lows. And we want to keep an eye on the 20-period simple moving average. It's not really causing a lot of concern right now. In fact, it's positive since it's green. That means that the S&P is above its 200-day simple moving average. But if we get above this green sorry, I do know my colors. If we get above this blue dash line here, then that's when we start to get a little bit concerned. That means we're getting far away from the 200 period simple moving average. And we're 8.4% above it right now. You can see other times. Now, I only picked 10% because it's a round number. There's no real hard and fast percentage that we look at here. But back in 2023, when we became overextended, then we saw a pullback. Then in 2024, we became overextended earlier in 2024, we saw a pullback. Then over the summer, we became overextended again, saw a more significant pullback. So we're just watching this. Right now, it's not really flashing anything to us, but we want to keep an eye on this nonetheless. Okay, then I haven't been showing a lot of the advanced decline studies. I have a lot of charts that I show, but then I stopped showing a lot of them because we're not really getting any additional insight from the charts that I do show in the daily videos. This is the cumulative advanced decline line for the S&P based on price. Still sitting near all-time highs and still looking pretty healthy when we look at this based on volume. Then shorter term is the advanced decline ratio based on 19 periods. We're above zero based on price. We're above zero based on volume. That's positive. Then we look at the NYSE cumulative advanced decline line. We're setting a new high here, and that's broader in scope. And we're just about back to the previous high when we look at the regular NYSE advanced decline line and this other NYSE advanced decline line, which is regular also, but calculated in a slightly different way. Then we break it out based on common stock, seeing a little bit of a lag here. So this can tell us, okay, the NYSE is doing really well, but not all the stocks are really breaking out. They're doing good, but they're not setting new all-time highs here based on price. But we can then lean a little bit more positive. We're seeing this breaking out a little bit here based on volume. And that's when it can be more positive when we see volume leading price. Now, we have not been seeing that with the S&P, but we are seeing it here with the NYSE. So the broader market is showing a little bit more strength right now than the S&P itself. Then we look at momentum to the S&P, really going sideways right now, not really showing any conviction one way or the other. And then US versus international stocks, tendency to drift a little bit higher. We see some weakness, and we see it bounce back up a little bit. We try to look at the bigger picture here, where this is improving. Where earlier in 2025, when we were really going down with the S&P, international stocks were really outperforming, and that was causing this ratio to go down. We've been gradually improving since that time, but then starting to level off more recently. Technical alerts are put out by stockcharts.com. I go through each one that applies to that particular day in the daily videos. These are all of the alerts generated for the whole week. We start at the bottom, that was Monday. Up on the top is Friday. When we're more positive, we see a lot of green. When it's more negative, we see a lot of red. And we were down on Friday. That's why we saw some more red overall. But we can just look at this in a color kind of way to see, okay, are we looking more positive, negative, or more mixed? Then I look at 6 index charts, and then I rank them on a scale of 0 to 100. The best performing index comes in first place and gets the highest score. And then coming in first place is the NASDAQ. This is the ETF that goes with the NASDAQ composite. It's coming in first place at 84.8. Then, believe it or not, just at the beginning of August, we were for a couple of days there actually down to single digits with the small caps. They really improved throughout the month of August, and they're coming in second place at 84.2, and the market is more favorable to small caps. If interest rates go down, if the Fed is coming in and cutting rates, but not cutting rates because the economy is falling apart, just to kind of tweak the economy and help it chug along a little bit better, because small caps have to borrow a lot of money, and that bites into their profits. And so they tend to thrive better in a declining interest rate environment when the economy is still looking pretty healthy. And as of right now, that's what it's looking like. So we're seeing some improvement here. And then we're seeing the QQQs, which that's the main growth area, coming in third place at 74.9. Then we have the S&P, which is a balance between growth and value, coming in at 66.7. And then mid caps are improving. They were down into the single digits as well, at least in the 10 range, and they're coming in at 55.1. And then the Dow, which is coming off of recent all-time highs, it's the worst performing index right now, but even it's above 50. Usually above 50 is more positive, below 50 is more negative. It's coming in last place right now, but at 52.7. Then a short-term rainbow going from 10 periods up to 50 periods. Even with the decline that we've seen here, we're still above the rainbow and all the lines are still going up. This is suggesting the short-term trend is still positive. Then we want to keep an eye on the 20 period simple and exponential moving averages. So far, when we came up out of the lows and we finally got back above the 20-day moving average, with the exception of one day, we've been above the 20 period moving average, and that's quite positive. Now, we fell down here a month ago when the employment report came out at the beginning of August, and the market didn't like the report. Well, we fell down below the 20 period moving averages for one day and then got back above them. Now, this upcoming week on Friday, we're going to get the employment situation report again. And so the market's really going to be anticipating that. It didn't react positively last time, at least initially, but then we saw a bounce up from that. What's going to happen in the next report? Well, we'll be watching for that in Friday's session, but we're still positive with the short-term trend here based on 20 periods. Then another intermediate term rainbow from 50 periods up to 100 periods, well above all the lines in the rainbow, and all the lines are going up. Intermediate term trend is positive. We look at the 50 period moving averages, and we're still above the 20s. So there's been really no need to show this chart in the daily videos. We're still going up with both the simple and exponential moving averages here, and prices above both of them. That's showing that the intermediate term trend is positive here as well. And then a little bit intermediate to somewhat long term is the 100 period moving averages. They're going up as well. We look at the Connors RSI, which is a momentum oscillator. I only show this chart if we go extreme positive or extreme negative. We're not there right now. And then this is percentages. And again, I have to eyeball this, and you move these lines a little bit and the whole percentage changes really quickly. Right now, this is more for informational purposes. If we do start to decline and really come down, we're going to be measuring the percentage of that decline. Because if you go back to 2023, we came down about 10%. Now, I measure this intraday, where most folks tend to use the closing values to measure what percentages, whether it's a decline, whether it's a pullback, whether we're actually going into a correction. If we go over 10%, that's correction. If we get over 20%, that's considered a bear market. We're just keeping an eye on this, and you can see other declines stayed within the positive percentage retracements before we started going back up. We did get down about to that 20% level when we were falling last spring, but again, this is an intraday basis, not a closing basis. And then right about at the 20% level, that's when the smart money really came in and started to buy, and we came up out of that. It was really crazy there for a while. We were chopping around all over the place. So for right now, this is more just for entertainment purposes. If we do start to decline, we'll be keeping an eye on this. We look at the S&P 100 and 500, and we saw a little bit of weakness, and it's still not really recovering with the S&P 100 outperforming the S&P 500, but we're not really seeing any divergences from each other right now either. The mass index not generating a signal. The weekly chart is, but that signal was generated a couple of months ago. When we see a signal is when we get above the red dash line and the blue line and then cross down below it. We're coming up to it, but we're not there yet. So there's no signal from this chart. We're below the moving average with standard deviation. This measures speed, not direction. So we're not seeing things going really quickly currently. And then the CMB composite, also another momentum oscillator. I show this if it gets above the black line or below the black line. We're in between the two currently. And then the percent B indicator measures if we're above or below the upper or lower Bollinger Band. And we're not, so there's no need to show this chart. It is leaning more positive because in the middle of the Bollinger Band is the midpoint. And when we're above that, that tends to be more positive, and the midpoint continues to go up. Then the point and figure chart, we did see a new X earlier in the week when we got above 6,500 on Thursday. Well, we fell back down below it on Friday. So there's no new signal after Friday, but there was after Thursday. This chart is positive though. When we see more X's than O's, that means there's more buying than selling inside of the S&P. And we're still working off of an ascending triple top breakout that was generated back on August 13th. So taken together, we see these blue lines. That's more positive. We were declining back in the spring. We've been able to break back above that. So when you look at this in total, it is a positive chart. Then a long-term rainbow above all the lines are going up. The long-term trend is positive. And we're positive with the daily chart of the special K. We finally crossed above the red line. We've been positive with the weekly chart, but now it's being confirmed by a crossover with the daily chart. And then we look at, again, I always explain it this way. This is an apples to oranges comparison. The S&P 500 is the bar chart. The red line is the NYSE advanced decline line because the S&P has its own advanced decline line. This is comparing a more narrow index, even though it's considered a broad market index, the S&P 500, with an even broader measure of the market, the NYSE advanced decline line, and they're matched up fairly well with each other. We're not seeing any real divergences currently. And then a weekly chart of the S&P coming off of recent all-time highs, a weekly chart of the German DAX just chopping around, holding up, but not really breaking out either. And then we look at the longer-term correlation between US and German stocks, or you could say European stocks, because the German market is the biggest stock market in the EU. The correlation is fairly strong between the two, and this is longer term since it's a weekly chart. Then this is a 20 period simple moving average of the open, high, low, and close. When we're above this little mini rainbow and then we come down, this quite often acts as support. Well, we continue to be above the rainbow right now, and the rainbow's going up. If we do start to decline and come back into the rainbow, I'll pull this back into the daily videos. All right, and then the Ichimoku cloud, still looking positive here. Green line, that's short term, even though we declined on Friday, but it's going up. Then we have intermediate term is the blue line, and then long term is the red line. And this is still looking more positive. We're above the Ichimoku cloud. The cloud is going up. The cloud is green. This chart is still positive. Broad market, we look at the VIXen, which is the volatility measure for the NASDAQ 100. I don't use it all that much. I look at it every day. I really only show it in this particular video. As we've been going down with volatility with the S&P, we've also been going down with the volatility of the NASDAQ 100. Then we look at the S&P and compare it to a growth to value ratio, and we're pretty much neutral right now. When we look at the Qs to that's growth to the Dow, that's considered to be value. The correlation is in neutral territory right now. Then the Dow and the transports. We're still seeing the red line, which are the transports lagging behind the Dow. They're improving and they've been going up recently, but they're not really outperforming where we have the Dow close to all-time highs here and just setting recent all-time highs. We're lagging here with the transports, and that would be considered a Dow theory non-confirmation, which the perma bears will pick up on and run with and declare that the market's going to go down 50%. Then we look at another ratio between regional banks, smaller banks, which are improving compared to the financial sector. Now, we're also encouraged that financial sector is setting new all-time highs. But going back to last spring, it's been underperforming the S&P. Lately, it's starting to kick back into gear and improving. It's still negative with the financial sector to the S&P, but we're trying to show some improvements there. So we want to see that improve. And this is even a little bit more encouraging when we see the smaller banks outperforming the financial sector, and the financial sector by itself has been doing quite well. So this is rather encouraging. If we can stay above both of these lines, we would generate a golden cross with the ratio. Bank ETF, not quite back to previous all-time highs here, but looking pretty solid. Energy to the 10-year bond ratio, coming back up a little bit, but after we really came up in 2021, this is when energy was really outperforming and the market was in a bear market. We since then have leveled off. So we're just kind of going sideways, not getting any real insight from this chart. Then the gold to stocks ratio, still down below this long-term trend line here. And then emerging markets to developed markets, pretty much going sideways with that ratio. Not seeing much conviction either way. Then we take the 10-year yield in the US, subtract the German 10-year yield. Okay, and then we plot that with the US dollar index. And the correlation between the two has actually been getting stronger lately, where they were tending to go in opposite directions there for a while. The German DAX, as I showed earlier, just kind of chopping along sideways, holding up, but still dealing with its 50-day moving average. But we're seeing a little bit of a breakout here when we compare US stocks to German stocks. We were improving, then we chopped sideways, and now we're breaking out a bit. And it's not that German stocks are going down, it's that US stocks have been actually improving with this ratio. Rate of change charts, very long term, going back 250 periods. We're still going up here with this chart, and this is a longer term chart, which it fell back a little bit here earlier in 2025, but now it's starting to show some improvement. Then I do a look at what is the market, especially the bond market, saying about inflation and interest rates. And I have a number of different charts that we look at with different maturities to say, okay, you can hear whatever the financial media is saying or whatever somebody posts on a blog or whatever YouTube video or Rumble video that people come out with and say interest rates are going to the moon, interest rates are going to fall through the floor, whatever. I pay attention to what the market is saying because that's really what counts. And we're actually seeing this ratio coming down. Now, this is a ratio between cash and 3 to 7 year bonds. When this ratio is coming down, that means that cash is underperforming. When this ratio is going up, that means cash is outperforming, and there's uncertainty about inflation and interest rates. This is in a downtrend and it's been declining, and we saw a pretty significant decline this past week. So, on a short term basis, the market's not concerned about inflation or interest rates. Now we look at some other maturities. We look at TIPS, which are Treasury inflation protected securities. If we're in a rising interest rate, rising inflation environment, people prefer TIPS. If this ratio is going down, people are preferring 3 to 7 year bonds. We were coming back up. There were some concerns about this, but we came back down. We're still in a downtrend, but we're above both the moving averages, but we're not really seeing an awful lot of conviction with this chart, which I would take as positive since the stock market has been going up. Then we use that same thing, going sideways here with tips to 7 to 10 year bonds, not really suggesting inflation is a problem right now. Then we look at the long-term bond in the S&P 500. That's the 30-year bond. We're keeping an eye on that one because it shows it going. This is bonds based on price here, where we were up earlier in August and we've come down a little bit from those levels. But if that really starts to go up in yield, which means down in price, that could be a problem for the market. I mainly focus on the 10-year bond, but this is the 30-year bond that we want to keep an eye on. So we look at the longer term correlation, which is dropping down, and fairly strong short term correlation between the price of the S&P and the price of the long term bond. Then we do that same thing. We look at the Qs, pure growth there with in red. This is the long term bond price. We're seeing it dropping down and getting more neutral now with the correlation between the two. Then we keep an eye on 2 year treasury yields. That's the short term. There's even shorter than that. There's 3 month, but this has been declining overall, and that has been helping the market to go up with shorter term rates going down. Then we look at another apples to oranges comparison here. The Eurozone stocks versus American 3 to 7 year bonds. Still holding up quite well, but really going sideways lately with this ratio. Then we have the percent of stocks in the S&P above their 200-day simple moving average. Now, I really focus on this chart if we get an extreme positive or negative reading. We're not there now. So we can use another interpretation of this. If we're above 50 and going up, which is what we're doing for the most part, this is still considered to be positive. Now we look at the 50-period moving average of those stocks in the S&P. We're also above 50 and going up. We look at the mid caps, seeing some improvement there, and then the small caps, which are also improving. So this is suggesting things are still quite positive according to these charts. Then this is really breaking out. Now it came down on Friday, but we look at the SPY, those are stocks, that's the ETF for the S&P, and then staples. And when staples are outperforming, this ratio goes down. And we saw that at the end of 2021. Then we went into the bear market in 2022. Well, we were really coming down with this ratio big time when stocks were falling last spring. Since that time, we've recovered. The ratio is going back up, and we're setting new highs with this ratio overall. This is still looking positive altogether. So thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.